And that's why I want to do a bit of a review today. Does that make sense? So for some of you, if you were in the class last night, you're going to be getting a second review. Good. That's what I want to hear, Anne. Given the level of this complexity of this information, I'm glad you think it's a good thing. Is there anybody here who doesn't think it's a good thing? Oh, Randy, you're too funny. You want to get to unconscious confidence. Okay. First, I want to thank Michael for doing the class earlier this week, and Tanya. So thank you very much. Yay, team. Let's begin. A short review is in order. So far, what did we learn in Modules 1, 2, and 3? In Module 1, we learned how to count waves, and we learned about wave personalities. So wave personalities for the impulsive waves as well as for the corrective waves. And we are now talking about corrective waves in Module 3. In Module 2, we talked about the impulsive wave structures and the impulsive wave extensions. Also in Module 1, let's not forget the fractal nature of the waves themselves and why we see waves repeating over and over again in any different time frame, which is why learning Elliott wave analysis is good no matter what type of trader you are. And I want to stress that point. Whether you're a day trader or a position taker or a swing trader, you can look at wave analysis. It will help you in your trading. It will reinforce, confirm your decisions that you are making, whether you're making split decisions, as in the case of a momentum day trader, or more analytical decisions and discretionary decisions as a swing or position taker. Elliott wave analysis is good for all trading types. So I think we got that message across pretty loud and clear in Module 1. And again, Module 2, impulse wave structures and extensions, and that's where we introduced Fibonacci and looking at calculating projections. And that's where Neil, I see that Neil is on, introduced a fabulous Excel spreadsheet where all you need to do is to type in the start and finish of the various waves as you see it to get the projections. Has anybody used the spreadsheet? Yeah. Is there anybody in the room that has used the spreadsheet on a particular currency sequence? And do you want to tell us about it? Or on a currency sequence, on a 5-wave sequence and corrective sequence that has already occurred and you were just testing it out? Well, that's something to do, So that's Module 2. And in this module, we learn about corrective moves and continuation chart patterns. Now, chart patterns in classical technical analysis are something that you learn about as part of your basic building blocks, your skill set. It would be incomplete without learning about chart patterns. So in this module, we learn about continuation chart patterns. In Module 2, we learned about what type of chart patterns in Module 2 did we learn about? This question is for you. I know the answer to it. Reversal chart patterns. Reversal chart patterns. Remember that? How to find the end of the trend. Reversal chart patterns. So impulsive wave structures, when we're looking at those, we're looking for reversals, the end of 5-wave sequences. And that's where the awesome oscillator comes in. That's where the, and that's where some of the other factors come in to determine the end of the trend. We don't need to review them here. So in this module, we look at continuation chart patterns, and what we notice is that these continuation chart patterns are very much Elliott wave patterns themselves. They're actually corrective moves in the 5-wave sequence, or following an impulsive wave sequence. Are there any questions so far? Good, because what do you suppose we're going to do in Module 4? Why don't I tell you? In Module 4, we're going to trade it. Absolutely. We're going to put it all together. We're going to look at an Elliott wave trading map to actually follow the trading map and trade the Elliott wave moves. Increasing position sizes when position size increases are warranted. So for example, when would you anticipate wanting to have your largest position, given what you know about wave personalities? Absolutely. So most of you said the start of wave 3, the end of wave 2. Absolutely. Absolutely. So that's what we're going to look at. But let's not jump the gun, because we're just going to talk about corrective patterns today. So before we enter into a corrective sequence, and we enter into a corrective sequence at the end of wave 1, 3, or 5, right? And we already know what the personality is, that the market is still bullish because we've just been in an uptrend, and we're not sure if this is a turn in the trend, or, a major correction, or if it's a small-ish correction. So the market is still looking to buy the dips, especially if it's the end of the wave 1, or 3. Or no, actually they might not know that it's the end of one of those, 5-wave sequences, so they're still looking to buy the dips in an uptrend. And this is where the bull trap comes in for the wave B. So the market sells off for an A, and then the market trades up for a B, and that's where the market jumps in and says, great, it's going up now, let's buy it. And that's the bull trap. And that's a good time to position short for a wave C. Now, what we're going to learn in this module is that the B can take on various shapes and sizes, as can this ABC correction. So it's not as simple as this. This is more or less a zigzag formation, which we're going to learn about shortly. And with the wave C, which is often called the killer wave C, when it does start, the market does start to move down. Anybody that bought the market in the B wave, in this bull trap, gets stopped out of their positions. So it's our job to be able to determine when this wave C is going to start and when it's going to end. And when it ends, it's over, and that's where we use our confirmations for the end of a trend to position ourselves long for the next move up. The two most important things, one of the important things that you need to know about corrections, corrective wave structures, are that they fall into two categories, sharp and sideways. Now, sharp is often called simple and sharp, and sideways and complex. The sharp family, when we talk about the simple and sharp family, we talk about the zigzags. When we talk about sideways corrections, we talk about flats, triangles, and combinations that are sideways. Both are corrective patterns. Both move against the trend. The sharp correction moves sharply against the trend, as in the name sharp. The sideways correction moves sideways against the trend. It looks more like a consolidation. So again, the zigzag is the simple sharp correction. The flat and the triangles are sideways corrections. There are variations for the flats and the triangles, which we're going to take a look at. The zigzag is the easiest one to trade, and that's where you get your ABC move and the killer wave C. That's when you get the biggest bang for your buck. When we're in a zigzag and B trades up, but not all the way to the start of the A leg, and then it comes down pretty hard for a C leg. These are the shapes and the forms that these corrections take. So notice the zigzag and the flat is an ABC 3 legs, and the triangle is a 5 leg. And notice that the triangle, it's similar to what you learn about in classical technical analysis, the ABCDE. Very similar, where the triangle forms, you have a thrust out of the triangle to complete the sequence. The zigzag is from the sharp family. It moves against the trend. And the B wave doesn't move as high as the start of the A wave, as you can see. Once the zigzag correction is done, it's done, and we continue to move up from there. But it's easy to get caught in that C wave. It's easy to get caught buying the dip, thinking that we're ready to move up because we think the C leg is complete. We've had a few of those examples where the C leg just seemed to go on and on and on, where we had extended waves in the C leg. And I'm thinking of the euro and the pound over the last couple of months, where we had, major C wave moves that just didn't seem to end. How does the zigzag break down into its subwaves? Can somebody tell me, how does the zigzag break down into its subwaves? Good, 5-3-5. That should become ingrained in you. When I ask you that question, you need to be able to say 5-3-5 very quickly without looking it up. 5-3-5. A is 5 waves. B is 3 waves. C is 5 waves. 5-3-5. Impulsive, corrective, impulsive. That's a zigzag. Now, what chart pattern looks like a zigzag? From classical technical analysis, what chart pattern looks like a zigzag? Yes, exactly. A bull or a bear flag. Flag patterns. Bull or bear flag, that's the correct answer. So you can draw a channel connecting the tops and bottoms. You can, and once you channel it, you can see the flag formation. And in an uptrend, we're looking at a bull flag. In a downtrend, we're looking at a bear flag. And this is exactly the zigzag pattern. In this case, it's a bull flag. Now, this flat pattern has another name in classical technical analysis. Does anybody know what it is? Okay, range, rectangle, rectangle, box, box, rectangle. Yeah, you're right, Bill. It's range bound, absolutely, and it's called a rectangle. And some people have named it a box as well. With this chart for this corrective sideways price action, this is where the oscillators come into play. This is where an oscillator such as an RSI or a stochastic or a MACD works very, very well. So when they get up to their overbought position on the oscillator, it's the time to go. It's time to go the other way, or oversold. There are 3 types of flats: regular, irregular, or expanded, and running. And we're going to look at these types shortly.
Could you repeat that last little bit, please, Jody? Thank you.
Sure. What I said was we're going to look at the 3 variations of flat corrections: regular, irregular or expanded, and running. And that's what you see on this slide. So can anybody tell me what the difference is between these 3 patterns?
Hi, Jody. It's Craig. The irregular, the B, doesn't make it over the origin of A, like on your chart there. Irregular, the B just makes it over, then corrects again. Then the running flat, you'll note the C doesn't make it to the end of A, meaning that it's a pretty strong uptrend.
Exactly, Greg. Thank you. So a running flat, just what you said, means that the uptrend is so strong that traders are impatient. They want to get in on the trend. They want to buy it before the corrective move is finished. So they do, and then it sort of just stops it there, and then it continues to go up. Now, the irregular or the expanded flat. Sometimes people miscount a 5-wave sequence and label that B wave as the 5th wave. That's easy to do, isn't it? Because the B goes above the previous high. So that's easy to do. And you can see that when we look at the internal count of the flat, we will see that a B wave has 3 waves. So if it's only 3 waves, it's likely a B wave. It's not going to be the 5th wave, because if the impulse wave has 5 waves. The B wave has 3 waves, and we're going to see that on the next slide. The flat has a 3-wave ABC form. A and B are both 3-wave forms. C is a 5-wave form. So this can be called corrective, impulsive. So again, if the B wave has only 3 waves, that's a good indication that, if in the case of an irregular flat, that it is not the end of a 5-wave sequence. Rather, it is part of the corrective sequence. And you will see this over and over again. It's pretty common these days in the currencies to see the irregular flats. Triangles are great patterns. The only problem with triangles are that they have 5 legs, and you don't know you're in a triangle until it's almost over. Now, Bill, your question is, are all flats 3, 3, 5? Yes, they are. They're all 3, 3, 5. Good question. So with triangles, you have converging channel lines in the case of a contracting triangle. And these types are symmetrical, ascending, and descending. And you have diverging channel lines in the case of expanding triangles or reverse symmetrical. This is an example of a symmetrical triangle. It has 5 legs. It's a sideways continuation pattern. In this case, the trend lines are converging. And it's a 5-wave structure, as in an A, B, C, D, E. But each leg is 3 waves. Each leg is 3 waves. Now, the great thing about triangles is once you see that the triangle is really panning out, you can trade this triangle. Just like you trade a triangle in classical technical analysis, you can trade it the same way. And the measuring objective is you take the distance of the widest part of the triangle and you project it for its move. And that's once the triangle breaks out of the channel lines, you know that it's going to go a distance, at least the distance of the width of the widest part. So I love chart patterns, and once you link them to the Elliott wave corrective patterns, as we're doing now, a light bulb can go on. Same thing in the case of the impulsive wave structures, where we had the reversal patterns, the rising and the falling wedges, for example, the diagonal fifth. I mean, it just fits in so nicely with Elliott wave analysis. Here are the 4 types of triangles: the symmetrical, the ascending, the reverse symmetrical, and the descending. The ascending has a flat top, the descending has a flat bottom. They're all continuation patterns. They move in the direction of the trend when they break out. Now, yesterday somebody brought up a good point, which I want to mention here, which is that sometimes you see a triangle that looks like a triangle at the end of a trend, and it actually doesn't continue in the direction of the trend. It reverses. And that's because it's probably not one of these triangles. It's probably a rising wedge or a falling wedge, because you still see the same A, B, C, D, E as in 1, 2, 3, 4, 5, but it's most likely a rising wedge or a falling wedge, and that's why we have that reversal. Each leg in a triangle has 3 waves. This is the internal structure of triangles. Each leg is 3 waves, so the internal structure is corrective, 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 corrective. You know we're in a correction, by the way, in a triangle or even a flat when we have, or in a triangle in particular, when we start out with 3 waves and we trade another 3 waves. What other corrective pattern starts out with 3 waves? A flat, exactly. So you might have a flat ABC where A and B are 3 legs, and you might have a triangle ABC, or the start of a triangle where A and B are 3 waves. In both patterns, you're gonna know that the next move is going to be the C leg, whether it's the completion of the flat or a triangle. So once you see a 3-wave move and then a 3-wave move in the opposite direction, there's a good chance there's going to be a 3 or a 5-wave move. The 5-wave move would complete that corrective sequence. That would be a flat. And a 3-wave move in a C would be a triangle. So you can look for these patterns in the market. Now, just as in Lego, where you have a bunch of building blocks, well, you have that here as well. The building blocks, when linked together, form double and triple zigzags. In the case of linking 2 zigzag patterns together to form a double zigzag, or 3 zigzag patterns together to form a triple zigzag. So think of it as building blocks. You know your basic structures, your zigzags, your flats, and your triangles, and now we're going to put them together to form combinations. Here we go. Here's your double zigzag. 2 zigzag patterns linked together. When you have an ABC, you call that the W. And then you have a correction, you call that the X. Then you have a second zigzag, ABC. You call that the Y. The zigzag moves sharply against the trend, and it forms a WXY from where both W and Y are zigzags, and X is the X link. Now, X in itself is how many waves? On the chart, it looks like it's only 1 wave, but actually X breaks down into a 3-wave pattern itself. We just haven't shown it that way on this chart. So just know that the X wave is also an ABC, or some type of corrective structure. It's an ABC, it's a 3-wave corrective structure. Now, what do we want to say about zigzags? Let's say we're in a wave 3, and let's say we've completed the wave 3 and we're ready to do a wave 4. And you take your Fibonacci tool and you measure it on the length, from the start of the wave 3 until the end of the wave 3 to get some retracements for your wave 4. And let's say after the first zigzag, the zigzag hits 23.6% or thereabout, or even 20% of the wave 3 up. You might expect that, we're going to, that maybe this isn't enough of a correction and that we need to go lower. But first, the market has to trade up in 3 waves because the zigzags need, they need to be linked together with something, and they're linked together by the X wave. So once this X wave completes in 3 waves, then you see another. You suspect that we're going to have another zigzag because a zigzag is a sharp correction, and that's what we need to correct down to the 38.2% or the 50% of the wave 3 move up. Since wave 4 is usually traveled between 38.2 and 50% of the wave 3. Sometimes they have, there are shallower corrections. 23.6 is enough, and a strong trend. So that's one way of telling or of suspecting that the zigzag move or the corrective move isn't finished yet. And that's very helpful to understand. In the case of a triple zigzag, it just means that even the double zigzag didn't cut it. We just didn't quite move down as much as we needed to for the corrective sequence. And I don't know for a fact, but I would think that triple zigzags are mostly found in a wave 2 position rather than a wave 4 position, because normally wave 2 travels more on a retrace than the wave 4 does. So a wave 2 can correct almost the entire wave 1 sequence, and in order for that to happen, it really has to be a double or a triple zigzag or a single zigzag. In other words, the correction usually needs to be sharp for it to correct more than 38.2%. And a wave 2 can correct up to 100%, but not more of the wave 1. So a triple zigzag forms a WXYXZ. You see the W, the Y, and the Z, and they're all linked by that X wave. That's the link, and the X wave is 3 waves in itself. So how can you tell if the zigzag is finished or not? Well, the clue lies in the X wave. If the X wave moves up in 3 waves, then, most likely we're going to have another corrective sequence following. If the X wave, however, moves up in 5 waves, and it's an impulsive wave structure, then perhaps the correction is over. And being able to spot the 3-wave moves from the 5-wave moves will become very, very important in your Elliott wave journey, and it's not always easy to do. I'll just tell you that it's not always easy to see if a move is 3 waves or 5 waves. We can use the awesome oscillator to see that, but it's not always easy. Are there any questions at this point?
Yeah, there's such a thing as a quadruple zigzag, and having answered that, there's such a thing as a double triple zigzag.
I don't know. A quadruple zigzag. Not sure about that. That's a lot. Double, triple zigzag. I don't think you would call it a double, triple zigzag. And if you mean 2 triple zigzags linked together, no. I mean, that's a bit much. But when you mention that, it brings to mind that even within the zigzag patterns themselves, there are variations, which we are going to see. We're going to see that the B wave might not necessarily be, we know that the A and the C are 5 waves and the B is 3, but the B can be either a zigzag or a flat or a triangle in itself.
Is a combination pattern ever more than a triple? Or is a triple and 2 X's as long as it gets?
Yeah, go ahead and answer that one, because I was just going to follow up with the same thing. Can you have another pattern show up after a triple zigzag?
I don't know. Elliott just talks about the triple zigzag. He certainly doesn't talk about the quadruple zigzag. I've never seen it or heard about it. But Bill asked the question, could you repeat what 3 or 5 on the X means? Yeah, that's really, really important. It's an important distinction. So let's say we have a zigzag move down, an ABC zigzag move down, and we think, okay, we had our 3-wave correction. It corrected 38.2%. We're off to the races. We're going up. We're going up, right? So we have an ABC down. We call that an ABC zigzag correction. Now we think, great, we're buying it. We're starting to move up to continue to resume the trend. Now, what we're looking for is the first impulsive wave structure once the trend begins. We're looking for a 5-wave sequence up, because impulsive wave structures are 5 waves. Impulse wave structures are 5 waves. So once we've corrected, let's say this is a wave 4, we're looking for a 5-wave sequence up for the wave 5, or at least wave 1 of wave 5. We're looking for a 5-wave sequence up. If we have a 3-wave sequence up and then we start to move down again, then we can say, oh, I guess wave 4 is not finished yet. We're due for another corrective sequence. So that's how you tell. If the X wave is a 5-wave sequence up, it's not an X wave. It means we're resuming the trend. If it's a 3-wave sequence up, it is an X wave. because we're going to have another correction. Thanks for asking that question, because that's a really important point.
So when a triple zigzag is finished, you drop down and you get your Z wave, that's it. It has to go up from there?
It has to go up from there if it really is the fourth wave or the wave 2 or the wave 4. Yeah. If our count is wrong, then our count is wrong. And it's not a triple zigzag at all. It could be the start of well, let's just see how else this could be labeled. Well, as long as we move down in 3 waves and we correct up in 3 waves and we move down in 3 waves and correct up in 3 waves and move down in 3 waves, then we're going to trade higher. If at any point during that sequence we trade down in 5 waves, then something is wrong. So for example, if in this last, the Z leg here, if we go A, B, C, and then we move up a little bit and come down for a 5-wave sequence, then we've got to take another look at it, right? As long as we trade in 3s, we're still in a corrective mode. So with the euro right now, you could argue that we have a double zigzag. You could also say that we're not out of the water yet and that we could be forming a triple zigzag. But as long as we just correct in 3s, we're okay. It's still part of the corrective process. Go ahead, Michael.
Yeah, the way I've got the euro label, I'm finishing up the triple zigzag. When the currency comes back down to the lower trend line, I got that as a Z wave, and we're done. From what you said, we're done with our fourth. We're ready to go back and resume the trend. Is that correct?
That's correct. We just want to make sure that we don't go down in 5 waves, because the triple zigzag is a 3-wave corrective sequence. Now, we just talked about double and triple zigzags. There are other types of combinations. So, for example, flat combinations. And the flat combinations are called double 3s and triple 3s. And this is an example of a double 3. Bill, we are going to look at the euro. I have the euro as an example later on in a few slides. So we're going to look at the euro. Let's just finish with these combinations. Now, again, just to repeat, the flat combination is a double 3 or a triple 3. That's what it's called. So when zigzags are all linked together, it's not called a double 3. It's just called a double zigzag. But you can have a zigzag in a double 3. As long as you have another corrective sequence with it, it's called a double 3. So in this example, you can see that we've drawn parallel trend lines, a channel. You can see the channel. So this corrective sequence moves sideways. And within the sideways corrective sequence, we have the W, which is a zigzag. We have the X wave, which is the link. And then we have the ABC, Y, which is the flat. So we have 2 types of pattern corrective sequences connected by the X wave. Now, the X wave travels to the top of the channel. So that's one clue that we're not going to continue down to have another zigzag pattern. Because if we were going to have a zigzag pattern, then it's not going to be sideways. It's going to be sharp. And it means that the X wave will not travel as far as it does in this example. That's an important point to be able to tell to see what's unfolding in the sequence. Is it going to be a double zigzag or is it going to be a double 3? So the distance that the X wave travels is a big determinant as to what the next corrective sequence will be. Are there any questions? Does that make sense? So what's the internal structure of double 3s? The internal structure of the double 3 is as follows. Because we have a zigzag as the W, the internal structure of this W is 5, 3, 5, only because it's a zigzag. The X wave, as we've drawn it here, is a 3 wave. If it's a zigzag, it's also a 5, 3, 5. If the X wave is a triangle, it's going to be an A, B, C, D, E. If the X wave is a flat, it's going to be a 3, 3, 5. The internal structure of the Y, because it's a flat, is 3, 3, 5. So it really depends what the W and the Y is, which pattern it is, that will determine the internal structure. But certainly the WXY is corrective, corrective, corrective. You see 3 waves for the W, 3 waves for the X, and 3 waves for the Y, no matter what corrective pattern it is. So this is putting the building blocks together. We start out with our flat, we start out with our zigzag, and we have our X wave, and we just build it. So your flat, your zigzag, your triangle, it's part of the foundation. Now, question, if the X wave were a 5 wave, would there not be a Y wave? The trend would have resumed. Exactly. You got it. There would not be a Y wave. The trend would have resumed. Absolutely. So what comes after double threes? And if you say triple threes, you're right. Now we're going to look at triple threes. Triple threes also move sideways against the trend. They're not zigzag. This does not look like a triple zigzag, does it? Because a triple zigzag is sharp, which is why the triple zigzag normally shows up in a wave 2 position, and a triple 3 would normally show up in a wave 4 position. It's not a rule. It's certainly not a rule, but that usually is the case. So the triple 3 moves sideways against the trend, and it forms a WXYXZ. Now, if we had a quadruple 3, it would have to form, what would it form? A WXYXZXA? Maybe that's why a triple 3 is it, WXYXZ. Maybe that's why he named it as such, because WXYXZXA doesn't sound right, does it? So the W, the Y, and the X are linked by an X. Now, we have 3 different corrective patterns in this sequence. 3 different corrective patterns. In fact, all 3 of the building blocks are here. We have our zigzag in the W position. We have our flat in the Y position. And we have our triangle in the Z position. And talking about triangles, a triangle is always found in the last position of a triple 3 or a double 3. It's often the breakout pattern, that triangle, which is why you can trade that triangle on its own. You just draw those trend lines, the converging channel lines, the diverging channel lines, and you take that breakout trade with your triangle. It's a good one. Whenever you see a triangle trade setting up, look to trade it. It's a good one, and it usually comes at the end of a long corrective sequence. It's when the market has been, think about the psychology behind the triangle. The market has been trading sideways. Finally, it gets to a point where it just doesn't know where to go, up or down, up or down, up or down, and that's when the triangle unfolds. And the market, you have your bulls and your bears, your buyers and your sellers. It's like a tug of war, buying and selling and buying and selling and buying and selling against that channel, not knowing which way it's going to go, and then finally it breaks. Now, knowing Elliott wave analysis, you know that it's going to break in the direction of the trend because it's a continuation pattern. So when somebody says to you, well, look, we're just trading sideways, we're going nowhere, they really think we're going nowhere. But you know where we're going because this is your roadmap. You know we're going to go up once this completes. This gives you the edge, guys. It gives you the edge, and it gives you some trading confidence that when we do break, especially if you see the triangle, there's a good chance we're going to break in the on the continuation side. Up in this case for the uptrend. So again, in this example, the W is the zigzag, the Y is the flat, and the Z is the triangle. Now, what's the internal structure of triple threes? Well, the zigzag is a 5-3-5, but in its sense, on its own, it's a three-wave corrective pattern. The flat is a three-wave corrective pattern, and the zigzag is and the triangle is a triangle. So it's corrective, 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 corrective. The X waves are also correctives. So suffice it to say that corrective sequences are either three waves, or in the case of a triangle, it's an A, B, C, D, E, but each leg is three waves. So for each corrective sequence offers a three-wave corrective sequence. And again, in this example, you have your zigzag. Breaking the zigzag down, it's 5-3-5. Breaking the flat down, it's 3-3-5. And breaking the zigzag down, it's 3-3-3-3-3. Why are Y's always a running flat? No. In this example, this is not a running flat, although it might appear to be. The C wave should really trade a little slightly below the A wave, but this is meant to be a regular flat. This was just drawn for illustration purposes. So in fact, you know, we could have had an irregular flat in this Y position, or perhaps a running flat in this Y position as well. And the X wave, as we know, is always a three-wave sequence. Who knows what the concept of alternation is? Who would like to state the concept of alternation?
If a wave 2 is sharp and simple, then the wave 4 is going to be opposite, complex, and flat, sideways.
Absolutely. And just know that it's a guideline. It's not a rule. So this particular is a guideline of alternation. It's a guideline. So exactly, if wave 2 is simple sharp correction, then a wave 4 will be might be a simple sideways or a complex sideways correction with combined patterns. Now the reverse is true as well. If wave 2 is a sideways correction, then it could be that wave 4 will be a sharp correction. Now here's where we talk about alternation within the B wave itself. Now this is a zigzag. So the A wave and the C wave are 5 waves. The B wave we know is 3 waves, but that B wave can be a flat or a triangle, and it can also be a zigzag. So it can alternate between zigzag, flat, and triangle. Now if it's a triangle, then it's likely that the measuring objective of that breakout in the triangle will be less than where the C wave ends up. But still, you don't need to catch the whole move. You can catch a portion of the move and take that breakout of the triangle and use the measuring objective of the triangle, or look for the 5-wave sequence in the C wave. The B wave can also be complex. You can have a double 3 or a triple 3 in the B wave, and if it's a wave that you can't count, rule of thumb is that it's probably a double or a triple 3. If it goes on and you just don't feel like counting it, it's probably a double or a triple 3. And then what you do is, you know, the other thing that we learn in classical technical analysis is that the longer the channel, and we're talking about time, the higher the probability of a breakout soon. So as this B wave progresses, if you can count the triple 3, fine. But if you can't, just channel it. And then you know which way it's going to break out based on the continuation, the consolidation nature of a B wave, so you can anticipate a move in the direction of the trend. Here's that Euro example. This is the 4-hour Euro chart. And I've labeled the top of the wave 3, and I've labeled it as a WXY. Now, I'm just looking to see if I honestly didn't really go through it that carefully, this is something that we can talk about. Does anybody see anything different on this chart? I labeled it as a WXY, and it looks to me like it's a double zigzag. But Michael, you mentioned that you're seeing a triple zigzag, so go ahead.
Yeah, if you moved your Y over to the previous swing low where it looks like you got a pair of railroad tracks, tweezer tops, that's where I labeled Y, and then we moved up for an AB.
Well, if you do that, let me see if I can. Let me pull up the chart for you, and let's have a look at that. Okay. Randy, you have a very good point. These complex waves are easier to see on bar charts rather than they are. And Elliott used candlesticks. Don't use candlesticks. They used bar charts. We're used to the candlesticks, so I sort of adapted to the candlesticks. But if you're seriously counting waves, yeah, go ahead and use the bar chart. Okay. Go ahead, Michael.
No, I agree with everything you got there until your last bar right-hand side. I had that to right nearly below the blue B. Oh, Blade already moved it, hadn't you? Yeah, Lee, put it back where it was. That big blue candle is your X wave.
So count, we haven't done the C leg down for that Z wave.
That's correct. That's the way I've got it. You know, originally when we finished, I believe, as the X, we had that listed as wave 1, but we thinking wave 2 came down and dropped below the Y wave, and so we had to abandon that and turn it into an X wave instead of a wave 1.
That's correct. Let's see, something else. Okay. I'm going to show you the bigger picture on the euro, because in order for you to understand, you need to look at the daily chart. So I'm going to show you that now. Now, if you look at this daily chart, now forget the lettering. Hold on one second. Daily chart, and I zoomed in so you can see the oscillator, and you can see the peak of the wave 3. I haven't labeled waves 1 and 2 on this chart. We can zoom out and see them. Okay, this is the last. Okay, this is the daily chart. It's the final wave sequence. If we really zoom out and see the whole picture, hang on, let's do that. This is the sequence, the euro sequence, going back from the low point of 116.40 in November of 05 until now. And I haven't labeled this chart, but when you do label this chart, you see that we are in the final, the fifth wave of this entire sequence. So I'm just going to show you this. We're zooming in on this portion, okay? So we're expecting this to be a 5-wave move, and this is the 3rd wave move, and this would be the 4th wave correction of this 5th wave. So let's call this 1, 2, 3, 4, and then we're waiting for that 5th and final move up. So when I drop down to the daily, we're zooming in on this last portion. And if I just erase these marks for a second, the chart that I showed you with all the corrections is this piece of the price action only. It's the corrective wave sequence only. Is that any clearer? And this is all I have on that chart, on the 4-hour chart. This sequence where I've labeled the top of the wave 3, and it's the top of the wave 3 of 5. So just get that in your head. This is the 5th wave. So when this move completes, whenever it does, it's over. And then we have a correction of this entire sequence, which will take us down. Got it? So we're in the final throws, the final move of this 5-wave sequence up. We're in the 5th wave. And let's just go back to the 4-hour chart so we can focus on this corrective wave pattern. So now, picture in your mind that we're in the 5th wave of this long sequence, and the top of the wave 3 is where we've labeled it here. And now we're in the midst of a 4th wave corrective sequence. We're looking at this corrective sequence because the subject of Module 3 is corrections. And since we've been in a very long corrective sequence for the euro, we wanted to highlight this. In fact, we've been in this corrective sequence since, let me get the chart up. This is the PowerPoint presentation. It looks like since April. Since April. Well, that's a long time to be in a corrective sequence. Let's get the chart back up just a sec. Here we are. So now the only question is, are we ready to go up, or in fact, are we not done with this corrective sequence, and are we going to make another move down to complete a 3rd zigzag of this double zigzag or triple zigzag? And that's why we look for 3-wave moves and 5-wave moves. What would give us comfort on moving up is if we have a 5-wave sequence moving up. Now notice this, we talked about that. Look at this X wave. Notice how we move up in 3 waves. Now, the market at this point, I can tell you, was ready for us to start to move higher, as was I. I was all ready for us to start to move higher. But we didn't move higher. We didn't move higher. We moved up in 3 waves, and then we came back down again. So we talked about this, that the X wave is very, very important. And if the X wave moves up in 3 waves, then it's usually a link between 2 corrective sequences. Now, let me just check something here, because Bill, you brought up a very good point, and that has crossed my mind as well. Let me just check something here, just a second. Yeah, Bill is mentioning that it looks like we're triangling here. Now, what you're looking at, Bill, is you're looking at this piece. You're looking at this, aren't you? Now, it's not a triangle, because a triangle is 5 legs, and I don't think we can have that kind of a pattern. I'm just trying to think, can we have that kind of a pattern? I don't think we can have a zigzag, zigzag, and then a triangle. I don't think we can, but I'd have to check that out further. But what we can have is we can certainly have a move up, and then a triangle, and then another move up. So the jury is still out. The question is, did we complete this corrective move yet, or are we still, waiting for another C wave move down to complete the Y, or to complete the Z in this case? And we're not sure yet. Now I'm putting the presentation back up because I do have a few more examples. Now what I've also drawn here, this is again the Euro example, the 4-hour, so I've channeled it. I've drawn a channel connecting the tops and the bottoms. Okay, I'm just having another look at it. I have another example, which is the dollar Swiss. Now this is a longer term chart. It's the daily dollar Swiss. And on this slide and the next slide, I have 2 different counts. So on this slide, we have a wave 1 down, a wave 2 up, a wave 3 down, and then a triangle formation, an A, B, C, D, E, which, if this triangle formation would continue, the move would be on a breakout down to the downside for the wave 5. Now this is a longer term chart, and what we can certainly do in the meantime is we can, now that we learned how to count to measure the correctives, we can actually measure the distance from A to B, calculate what that is, and see how far C traveled, etc. We can see if the triangle played out as we learned how to measure triangles, the moves in triangles. This is one count. Can anybody see a different count on this chart? And I'm going to show you that different count on the next slide. Can anybody see a different count? Okay. I know you just have so many different answers. Let me show you what it is.
Oh, that A could be a 4, and then the B could be a 5.
You got it, Anne. You got it. And this is what this is how I've labeled it here. Exactly what you said. We have a 5-wave sequence down, and you can see how the wave 1 moves down. The wave 2 is a sharp correction of the wave 1, right? The wave C is pretty extensive. It's long, it's sharp, it's impulsive. The wave 4 is very much corrective, and then the wave 5 is very much impulsive. So that could be the end of the 5-wave sequence. And then we could have an A up, a B down, and a C up, which will take us higher. So the dollar Swiss on the daily has 2 different counts, showing very different results.
If that second count is right, and the 4 goes above the 1, doesn't that mean that that would have to be a 1 or a 5 of a bigger degree?
It means because there's overlap, it means that it's a diagonal. It's a diagonal triangle. So it's still possible that we have that count. Could divergence in the downward movement of B give us a clue? Not really. Not really, no. We don't know. What could give us a clue is then we would take a look at the pound and the euro and maybe the dollar index and really get a view for the next big move. So we just talked about the euro. The euro has a clearer pattern perhaps in that we should be trading, up for the euro once this correction ends. So up for the euro means dollar down. And once the euro trades up to a certain point, the dollar down move is kind of finished, and we're going to turn around. So how does that play out in this dollar Swiss? Well, in this example, that would mean that the dollar has to move down initially, and then it will move up quite a ways. Now, I think that plays out better in the first scenario. Let's go back to that first scenario.
Can you explain how the Elliott wave applies to different currencies? I mean, is the Elliott wave that's happening in the U.S. currency then relative to each different country, depending on the psychology of the population of that country at the time, or how does that work?
All I can say is that each currency pair is different. Each currency pair has its own personality, and each currency pair has its own count. You're not going to find the same count in the dollar yen and the yen crosses that you're going to have in the euro and the pound. But you will find a similar count among the yen crosses. You will find a similar account, perhaps, between the euro and the dollar index. The dollar Canada trades on its own as well, as does the Aussie dollar. So you're not going to find the same counts in all of these currency pairs unanimously across the board. That's why when you're doing your Elliott wave analysis, if you're doing multi-currency analysis, you want to sort of, when the counts do line up, I mean, it's great. It's great when the counts line up. And on occasion they do. And when they do, it's just wonderful because it provides confirmation that a move is going to take place. But let's go back to this dollar Swiss example. And if given our view that the dollar will, the euro should trade up, and that the dollar will trade down initially. Oh, that's wrong. Hang on a second. Is that right? Yeah, exactly. So that would be consistent with the move, the breakout of the triangle to the downside, where the dollar moves down for the dollar Swiss. The dollar moves down against the euro. And then once the dollar Swiss reaches the bottom and completes its 5-wave sequence, it should turn around and trade back up again. And that's the same case with the euro. So I like this count better than the other count, for sure, based on my view on the euro. But we'll see how it plays out, won't we? Let's move to a smaller time frame. Let's look at this pound. Now, let me see where the let me put up a refresher chart. Hang on. Well, actually, looking at this chart, now this question is for you. This is an hourly chart on the pound. And take note of the awesome oscillator. Take note of the peak of the wave 3. What do you have? What is this chart saying to you? Where should the next move be? And I'd like somebody to participate who hasn't participated yet. With your microphone, somebody grab your mic and talk us through this chart a bit.
I don't think I can talk you through it, but it kind of reminds me of a bull flag.
Great. Who wants to add to that? Where do you find bull flags? In what waves?
Hi, Jody. It's Greg. What do you want to know about this chart? It looks like, what else do you want to know? You've got it labeled pretty good. 4th wave bull flag, probably. Geez, what else do you want to know? It looks like it's going to go up for the 5th. Well, the awesome is telling us that it's gone back to the equilibrium, to the 0 line, so the conditions for wave 4 have already been met.
Excellent. That's what I wanted to know as well. And I'm just putting up the chart now again.
I noticed also the awesome oscillator below the center line or 0 line, indicating that 4th wave. That's
right. And where I've labeled the 3 at the peak of the awesome oscillator, that's why I labeled the 3. What Greg just said is what Neil had said earlier, Judy, which was that the fact that the awesome oscillator goes down to the 0 line, crosses the 0 line, means that the minimum requirements of the wave 4 have been met. We studied that in Module 2 as a refresher, that the minimum requirements for the wave 4 have been met, and that now we should start to go up. And when we do go up, we will see divergence between this peak in the wave 3 and the wave 5 when it ends. So in other words, the oscillator, will move higher once this breaks out to the top side, and it will not surpass the top of this wave 3. We will see divergence. Now, this is a classic setup. Let's hope it pans out that way because it's just screaming out for it to move up. We have our bull flag. We have our awesome oscillator peaking at wave 3. And by the way, that's how I labeled this chart. I did not count the subwaves. I do not count subwaves. I let the awesome oscillator tell me, what's going to happen. Now, there's another possibility, which is that we just trade up in 3 waves, which is corrective, and now we're going to trade down in 3 waves. So if this does not take out the high of the wave 3 and complete a 5-wave sequence and goes down, well, then we can say, oh my gosh, this, once again, we had a 3-wave move, and then we're going to have a 3-wave move in the opposite direction. Go ahead, Ann.
I have a question about the awesome oscillator in wave 4 going to the 0 line to meet the minimum requirements of wave 4. Is that, it's not doing it on the 4-hour, but it's doing it on the 15 and the 1 hour. So is that relative to the degree of that 4th wave that we're looking at?
Yes. Remember that that we need to see the appropriate. Hang on, I'm going to a smaller time frame. That we need to see the appropriate number of bars on the screen. So between 100 and 140 bars on the screen, and that comes right from Bill Williams' work with the awesome oscillator. So you want to see between 100 and 140 bars on the screen for us to see the divergence in the awesome oscillator and the awesome oscillator coming back to the 0 line. So now I've put up the 30-minute, and I guess I could still put up the hourly. But you can see how this wave 4 is really drawn out.
That would mean that when it does move, it should move a nice move. Is that right, Jody?
It should move up if this is going to be a 5-wave sequence up. And, we see that it's a bull flag, et cetera, et cetera. If it doesn't move up and starts to move down from here, then we can say that the 1, 2, and 3, as I've labeled it, is just another A, B, C, 3-wave corrective sequence. Question. I understand that often wave 3 is the most significant on the awesome oscillator, but not necessarily exclusively. Does this have to be a wave 3 you've labeled? No, it can be an ABC. It can be an ABC. If we start to trade down from here, then it's not a 3. It's an ABC.
Jody, I'm wondering, the longer period of time that we're in this 4 as it's being drawn out, when we move out of it, is it often more violent move out of it? Like the longer you stay in a range, the faster you come out of it? I've heard about that.
Yeah, usually. I think I alluded to that earlier, that when we do break out, it's going to be a nice move. Now notice how the market is also, look at how the averages have come together on this. The 4 moving averages, the 8, the 13, the 21, and the 34. So that also means that the market it's very tight, yeah, that we're in equilibrium right now. We're not out of equilibrium. So when we do have a move, it's going to be a nice move. Question, but the flat downward movement or comment suggests to me that we're not going to go into a major downward move. Yeah, that's the nature of a bull flag. So I hope you're right, because this is a really beautiful chart pattern, and it would be nice for it to play itself out. Look for these chart patterns, and it's very nice. Now, having said that, if we come in on, let's see, Monday's a holiday, isn't it? So, but the market is open in Europe. So if we come in and we look at our charts on Sunday or Monday, and we see that we have moved up to complete this 5-wave sequence, well, we know we're also going to, and we see the divergence, we know that we're going to have a correction down. Like, we're not going to start buying it once we've broken out of this of this chart pattern and trade it higher, we're not going to start buying it at that point. We're going to wait for the pullback. Bank holiday in UK also on Monday. Yeah, okay. So it's going to be a very quiet, thin market. And we're not, yeah, it's going to be a quiet, thin market.
Jody, a question. Perhaps in stocks, I've heard that when there's a big sell going on, they get welfares to borrow them, but it causes sometimes an increase in price. Does it ever happen in the foreign currency markets when there's a big demand, everybody gets hot for selling? Does it give it that little bit of an impulse increase in demand before lack of demand?
I'm not sure I follow the question.
I was worried about that. I was thinking in the stock market, when everybody, does it pulse one way before it goes the other way, perhaps, just to get that sucker punch in? I'm wondering about that, like when all of a sudden everybody's short on a stock, sometimes the price goes up because they need the shares to short.
Yeah, okay. In currency terminology, absolutely. The market can take us out of positions and then move our way. How many times does that happen? How many of you have experienced that, where we get stopped out of our positions and then it goes our way? So in this case, let's just say we have a stop. Let's say we have a buy on this wave 4 and we have a stop below the trend line. And exactly, Neil is saying throw over or under. So in this case, let's say the market comes down, it knocks us out of our position, and then trades back up again, which is why setting stop losses are so important. So important. Absolutely, the currency markets have a tendency to knock us out of our positions. So I frequently leave a pretty wide stop loss on my position.
A good example would be the bottom of your 2 there. We didn't know much about what type of wave we were in, and that sucker just rallied down there before she had that nice rise.
Yeah, for sure, absolutely. Yeah, that's a great example of that sucker bee, the sucker bee. Let's just, yeah, that's a good example because you can see. I can't really blow it up. I'm on PowerPoint again. But here we come down for an A, we move up for a B, and the market is gearing up to buy it. They think it's going up, and then boom, the C leg takes us out of our positions. If we don't know Elliott wave analysis, of course. But by knowing this, we know that the wave 2 can correct this entire wave 1, and we're prepared for that A down, B up, and C move down before the start of the 3rd wave. So now that you know that, you won't get stopped out of your positions as easily as you would by not knowing it. Does that provide comfort to you? It should. So thank you for mentioning that. That's excellent. Now, we have about 20 minutes left, so I thought that I would just continue going through the presentation very quickly and look at some chart patterns. So now we're into Fibonacci retracements and targets. This is an example of a 1, 2, 3, 4, 5 wave chart sequence, and the wave 4 is circled. So why is the wave 4 circled? Oh, this is interesting. Okay, I see. In this example, this is illustrating 2 things. One, it's illustrating the guideline of alternation, so that wave 2 is a zigzag, and wave 4 is a sideways, and it happens to be an irregular flat correction. So this illustrates the guideline of alternation. Now, it also talks about wave 2 targets. So wave 2 targets are usually between 50 and 61.8% times wave 1. So you use your Fibonacci tool from the start of wave 1 until the end of wave 1, and the retracement targets that you get will show you 50%, 61.8, and 38.2%. And usually the wave 2 comes down between 50 and 61.8, or even more than that, but it doesn't exceed it doesn't come below the start of wave 1. Now, in this example, we're looking at the wave 4 targets. So the wave 4 has a different personality than the wave 2, if you recall from Module 1. In Module 1, we said that the wave 2 has normally deeper corrections than that of the wave 4. So in wave 4, a rule of thumb that we use is that wave 4 correction sometimes is very shallow, so it corrects 0.236 times wave 3, or 23.6% times wave 3, up to 50% times wave 3. Those are the most likely targets. Of course, the wave 4 can correct more than 50%, like 61.8. Absolutely, it can. But these are the most likely targets. And certainly in an extended wave, you will see wave 4 correcting less than 38.2%.
I understood that wave 4, the most likely target, is the bottom of the subwave 4 of the previous wave 3.
Yes, that's absolutely true as well. And I haven't even mentioned it on this slide, so glad you mentioned that. So what we can do is we can draw a line across, and you see the previous subwave 4, right? You see the previous subwave 4? Okay? So we have 1, 2, 3, 4, 5 of 3, right? So very often the wave 4 corrects down to the previous subwave 4. So the wave 4 of the lesser degree. The wave 4 of the lesser degree. That's how it's said. So that's a good note. So you can use that in conjunction with the wave 4 targets. Go ahead, Neil.
And is it right that subwave 4 or wave 4 of a lesser degree is the most common turning point?
Yes, it is, actually. It is. So when you draw your Fibonacci, let's say you draw your Fibonacci on this leg, and if this happens to be 38.2%, then that's going to be your most likely target for the wave 4. So I'm really glad you mentioned that. I think some light bulbs are going on with this. Are they?
Absolutely. My brain's going off at a tangent now because I'm trying to work out how to build that into the spreadsheet.
Okay. Now, zigzags have their own targets as well. So, zigzags have their own targets. This is a wave 2 zigzag, but it could be a zigzag anywhere. The point is that the wave B retracement depends on the pattern of wave B. Remember we said that the wave B in a zigzag can be a zigzag itself, or it can be a triangle. It can be a flat, or it can be a triangle. Now, a zigzag B normally retraces between 50 and 79% of A. A running flat B, this is a typo, a running flat B retraces between 10 and 40% of A. Now, I don't know, that says running flat. It could be a normal flat, a regular flat, and it can also be an irregular flat. I believe the percentages are the same. And a triangle normally retraces between 38.2 and 50% of A. So again, knowing the pattern, the pattern of B itself is very important. Now the wave C targets, the target that is the most common is the equality with wave A, where the C wave equals the same distance as the A leg. Other targets, 0.618 times A, and 1.618 times A. Now, we're not going to go through all of these retracements and targets because you can write them all down on a cheat sheet, and I believe Michael put one together and posted it, which was very nice of you, Michael. And you can, keep this in front of you when you're measuring your waves. Let's just move to triangles, and let's just talk about triangles just for a minute. This is an example of a symmetrical triangle in a wave 4 position, and there are two ways to measure the legs. One way is where alternating legs are 0.618 times the other. So in other words, wave E will be 0.618 times the alternating leg, the C leg. And then the C leg will be 0.618 times the A leg. The other way is where each leg is 0.618 times the previous leg. So point E is 618 times wave D, D is 0.618 times C, C is 0.618 times B. And again, you don't know that a triangle is playing itself out, so you have to start with the A leg and then take 0.618 times that to project the B leg if you're anticipating a triangle, which you really can't do. The last thing that I wanted to talk about and I wanted to review are chart patterns, classical chart patterns, comparing them to Elliott wave patterns. So I can't stress enough how important it is to look for chart patterns in the data. Learn those chart patterns, learn them well, and look for them in the data because they will take you a very long way. And understand that these chart patterns can be explained by Elliott wave analysis. It's just beautiful when you can connect chart patterns with Elliott wave analysis. I remember the first time I did the presentation on Elliott wave analysis back in May or June, last May, a year ago actually. And so many light bulbs went on when we showed that connection. And now you guys know that already. So it's not news, but I want to stress it anyway. So what are the three patterns that we learned about today? Zigzags, triangles, and flat corrective waves, right? These are the three patterns as we name them in Elliott wave analysis. Zigzags, ABCDEs, or triangles, and flat corrective waves. ZSNTs. All right. Now, these patterns have different names in classical chart pattern analysis. So a zigzag, as we now know, is a bull or a bear flag. A triangle in Elliott wave analysis is a triangle in classical chart pattern analysis. Symmetrical, ascending, descending, expanding. Simple, simple. And a flat corrective wave is a rectangle formation, or you can say it's a box or a channel. It's any number of things, but you can certainly channel it. You can draw a box around it. It's a rectangle formation. So it's really, really, I think, pretty impressive. Now, here are some examples. This is the Euro daily chart from January to May 2005. So you can see that little fourth wave pattern there. It's a triangle, A, B, C, D, E. We break through and we trade down to complete wave 5. The next example. Now, you definitely have to put this into context. I'm only showing you the chart pattern in relation to the price data before and after. We're not putting it into context necessarily. However, this wave 2 correction of the wave 1 move is sharp and steep. The wave 1 starts all the way back up there, comes down in 5 waves, and ending with the 5th wave thrust out of that triangle, and then we correct. And we have a long A, a 3-wave B, and a 5-wave C. So a 5-wave A, a 3-wave B, and a 5-wave C. Notice how waves A and C are quite impulsive, and wave B is very much corrective. You can see the 3 waves. So this is definitely a zigzag. You can channel it and call it a bear flag as well. However, it is a daily, and it's a very, very sharp correction. So, and it is in the wave 2 position, which is why many of you might not really consider it a bear flag. If this were in a 4th wave position, that's more common and more to what you're used to. But this is an example of a zigzag in a wave 2 position. And finally, we have somewhat of a sideways correction here. Perhaps C extended a bit too far, but I really don't know what other correction it is other than an irregular flat correction where B goes below the end of wave 1. So call this a rectangle. We've drawn lines going across, but of course the C wave goes through it a bit. Okay, this is another example of a triangle prior to a 5th wave move down. The bottoms are flat, so it's a descending triangle, and it thrusts to the downside. And here is another rectangle formation in classical technical analysis. And in Elliott wave analysis, this is a running flat. C does not quite touch the A. It's a flat correction. And finally, here we have our favorite complex double zigzag, ABCX ABC, or WXY, where you can see the A, the B, and the C for a W, then an X wave, and then an ABC for a Y. And again, this correction is sharp. It's not sideways. It's not sideways. So that's it, guys. That covers the material in Module 3. How do you feel? You have really come a long way. I hope you realize that.
Jody, this is Ann. I'm one of the newer ones, less experienced, but I have come a long way. I want you to know that. It's beginning to make a lot of sense, and I've overcome a lot of obstacles that you guys haven't had to deal with. I have the wrong web charts, so I've discovered, for one thing. So I'd like to know what web charts you all plan to use. Since I have the wrong ones, I don't have the awesome oscillator, and also can't add to my Fibonacci. Little things like that have held me back also, but it's really making a lot of sense. I appreciate it, and your charts are beautiful. And also I want to say that Thomas has put in the back ILC a really nice cheat sheet also that everyone might enjoy using.
Oh, fantastic. Well, I'm using the Pro charts, and I'm going to check out the new Trading Post charts. But you definitely want to get charts with the awesome oscillator. You definitely want to do that. And Thomas, it doesn't look like Thomas is on the line right now. Now, you can, again, you know, that's great question. I know I haven't had a chance to look at the back office yet or to look at the ILC yet. And thank you to Michael for answering all the questions. Michael's not on anymore. Thank you to Michael for answering all the questions and for you guys for posting stuff in the ILC so that everybody can learn from that. So keep asking your questions. You can always send me emails as well through, send it through the ILC. What we have to look forward to is Module 4, which should be coming out, I don't know, this weekend sometime. Should be coming out this weekend sometime. And you have that to look forward to. That's where you're going to look at the Elliott Wave trading map. You're going to learn how to trade an Elliott Wave sequence using money management. So it's very, very exciting. So I want to thank you all very much for persisting and for really putting in the effort and the time that it takes to learn this stuff. And you're not going to learn it overnight. Okay, you're just not going to learn it overnight. So, again, I've been doing it for a very, very long time, as you all know. Go ahead, Becky.
Jody, I was just wondering if you were ready to do the one-on-one sessions yet.
Yes, I am. I am ready to do the one-on-ones, and it sounds like you're ready as well.
Yeah, I'm ready, but I really think that, this has helped a lot, but I do have some questions. I don't feel like taking up too much time during the class to ask, so thanks.
Oh, Becky, you shouldn't hold back in the class. If you've got a question, the chances are the rest of us have as well, and we'd be only too glad that you asked it for us.
Okay, absolutely. Now, I'm just wondering, Judy, there's no OTR in advance on Monday. I think what I'm going to do now is this class is over. Okay, guys, thanks very much. Have a nice weekend.